Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Petrobras' stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Petrobras operates in three business areas. The first is exploration and production, the second is refining, transportation and marketing, and the third is gas and power. It controls significant oil and gas assets all over the world, although Brazil represents a majority of its production. Most of the oil and gas consumed in Brazil comes from this company. They're headquartered in Rio de Janeiro, Brazil, and was founded in 1953. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, Sao Paulo, Buenos Aires, Spanish Bolsa, and London Stock Exchange. Let's get started with the model. This is a large cap company, 92 billion market cap. They're trading at $14 a share, and they have 6.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. As you know, the price of oil has been getting high. So is their revenue and free cash flow. Their free cash flow grew from 1.7 billion to 34 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also peaks in the trailing 12 months at 28 billion. Revenue is the sales for the company, and that did drop in 2020 due to lower oil prices, but then it jumped way up to 95 billion in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that's been growing a lot from 30 billion to 47 billion. Gross margin is gross profit over revenue, and that went from 40% up to almost 50% in the trailing 12 months. Not only is their revenue increasing, but so is their profits. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that more than doubled from 2019 to the trailing 12 months. Operating margin is operating income over revenue, and that grew from 24% to a whopping 41%. That means in the trailing 12 months, they converted 41% of their revenue into operating profit. Below that is the interest they pay in their debt. That was 4.5 billion, which is a lot lower than 2019 of 6.7 billion. They spent 321 million on financing costs. And then you have other income and expenses. These are all the gains or losses not part of the company's core operations. In 2020, they had a large asset impairment. In the trailing 12 months, it's likely they had a large gain on the sale of an asset. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which nearly tripled from 2019 to the trailing 12 months. Net margins is net income over revenue, and their margins in 2020 were below 2%. Now it's nearly 30%. In order to understand margins better, you should compare them to other companies in the same industry. But you could also compare it to prior years within the same company, and a 30% net profit margin is just unreal. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. Then you have capital expenditures, investments in property, plant, and equipment. They spent a ton in CapEx in 2019, nearly 24 billion, and it looks like that large investment paid off because look how much operating cash flow they have now. A company like this always has to spend a lot on CapEx, not just to build new projects, but to maintain current ones. Operating cash flow minus CapEx gives you your free cash flow. They've been paying a huge dividend with their free cash flow, but they've been also trimming down debt. You can see in 2021, they added 2 billion of debt, paid down 27 billion. So they decreased their debt load over 25 billion in 2021. They decreased it 14 billion in 2020, and they decreased it another 25 billion in 2019. Let's look at their capital structure. 92 billion of equity, 59 billion of debt. They're 61% equity, 39% debt. Their net debt is 40 billion. Net debt is debt minus cash. The highest WACC on Finbox is 11.3%. I went even higher to 13%. because Brazilian companies tend to be pretty high credit risks, and I wanted to be conservative with my model. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $184 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $195 billion. We divide that by 6.5 billion shares. And we get a calculated stock price of $30. They're trading at $14, so they're trading at a 53% discount. It's a buy according to the model. Their revenue target for 2024 is 480 billion Brazilian reais. 1 real equals 21 US cents. So you can divide this number by 5 to figure out what it is in US dollars. It's 101 billion US dollars. And their revenue forecast for 2023 is 103.5 billion. For 2022, it's 113.5 billion. And I continued this trend into 2025 and I got 99 billion. That's how I got their future revenue estimates. They convert on average 26% of their revenue into free cash flow, so I multiplied their future revenue estimates by 26%. That's how I got their future free cash flows. Simply Wall Street values the company at $30. They're saying it's 52% undervalued. 3 analysts priced this stock and the average price target is 17. The low is 1650, the high is 1740. The Brazilian government has been mentioning they may take this company private. If you own shares in the stock and they take it private, then you'll get paid for what you own. But analysts are still skeptical if privatization will take place. This is where the stock has been trading the last 5 years. Before COVID, it was over $15 a share. And then when COVID hit, it dropped to around $4.50 at the low. But like most oil stocks, it's been climbing a lot the past couple of years. This red line here is the price of Brent crude the last 5 years. And you can see Brent crude is up 143%, and this stock is up 67%. And the lines are really similar. They pretty much go up and down in a similar pattern. So if you were curious if this stock will go up or down, you could just track the price of oil. Since they're making so much money with the high price of oil, they're paying a really big dividend. They pay a quarterly dividend, and the last one was $1.47. Their dividend yield in the past 12 months is 32%. The sum of their last 4 dividend payments was $4.48. So if you bought this stock at the COVID low, you might have gotten all your money back just in dividend payments. And they could afford this high dividend. It's 86% of their free cash flow. You can see how low their dividend yield was before 2021. At one point it got close to 40%. And I'm not sure this is accurate, but the projection is for their dividend yield to be 23% by 2024. The last time they did a stock split was 14 years ago, a 2-for-1. Then before that was 2007, another 2-for-1. They have a beta of 1.37, so the stock is a little more volatile than the market. It's gone up 24% in the past 52 weeks, while the S&P is down 3%. The 52-week low is 9, the high is 16. And the stock is trading above its 200-day but slightly below its 50-day moving average. Lots of trading activity on this stock. Nearly 30 million shares are traded each day. Of the 6.5 billion shares outstanding, 4.1 billion are on float. 23% are held by institutions, and 1/3 of 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd have $11,000 today. That's a 10% return. 38% of the company is held by institutions, 29% by the Brazilian government, 25% by the general public, and 8% by venture capital and private equity firms. Their employee count has been going down over the years. It was 80,000 in 2016. Now they're down to 45,500. Their biggest shareholder is the Brazilian government at 29%. Then the Brazilian Development Bank at 8%. BlackRock, GQG Capital Research, Vanguard, Bailey Gifford, Arrow Street, another Brazilian bank, Itaú, and Norges Bank. Let's look at their financial ratios. They have an amazing PE of 3.3, that's stock price over earnings per share, price to sales of 1.0, price to book of 1.0, and an unbelievable price to free cash flow of 2.7, that's stock price over free cash flow per share. They have a good return on invested capital of 24%. Their interest coverage ratio is 8.7. They have a high ROE of 31%, that's net income over equity. and they have a good current ratio of 1.5. That's current assets over current liabilities. Quick ratio is 1.2. They generated $34 billion of free cash flow in the trailing 12 months. They have $14.6 billion of working capital, and they pay out over $29 billion of dividend payments. So it looks like the company's pretty well capitalized. The best way to look at ratios is to compare them to companies in the same industry. There are 19 companies in the same industry as Petrobras, and if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a similar amount on CapEx as the average company. They have a really good debt to equity ratio. They pay a ridiculous dividend. They generate lots of free cash flow. They rank 8th in market cap of the 19 companies. All their price multiples are much better than the average. They generate less free cash flow than the average company. Their 5-year annual revenue growth rate is surprisingly flat. And they have a good ROA and ROE. So to summarize, I have them trading at a 53% discount. And if you own this stock in the past year, you're really happy because you're getting a really nice dividend payment. But I know the big concern is their Brazilian company. And the stock price for Brazilian companies doesn't go up nearly as much as more developed countries. And now there's a bit of a concern the company may get taken private. So I'm really curious to see how this company performs over the next quarter or two. I rank their free cash flows, revenue, and ratios 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.